Brilliant. Thank you very much to the organisers for having me here. It's obviously a pleasure to be here, and it's especially a pleasure to be discussing this paper. Let's just dive in and remind ourselves, QJ already pointed this out very clearly, this paper is addressing what I think is a very important question. How does organisational design affect information production and communication within a firm? And we should remember that we spend a lot of time studying the efficiency of allocation of resources between organisations through market transactions, but internal capital markets are really where an enormous amount of resources are allocated, and there's a significant room for inefficiency in those allocations. This research agenda is really about trying to open that black box up and say, let's learn something about how effectively are resources allocated within that structure. And let's begin by just asking, does information just pass from one part of the organization to the other, and what are the agency problems that inhibit that, okay? The specific questions that they're going to drill down on here are, does delegated decision-making increase incentives, and how does communication change with the length of a relationship, okay? So theoretically, that's just a small smattering of what's been done. There's a lot of theoretical work being done there. I think the authors view this paper as being closest to, say, Aghion and Tirole, in the sense that that paper looks at an environment where you can get more information produced and communicated if you delegate real authority to the agent, and essentially say, well, I know that my report is going to be used more often, so I have a stronger incentive to go out and work hard to collect that, okay? Let's remind ourselves for a second that despite the fact that there's been an enormous amount of theoretical work here, there's been very little progress made empirically, and there's been a few papers, which QJ cited already, but we should remind ourselves that it's very difficult to do this. One, because we don't have a lot of data within firms, okay? So that's challenge number one. Challenge number two is that even if we did, if we saw the communication, in most instances it's very difficult to quantify or make any sense of whether it's more or less informative, okay? So in here we're going to look at a banking setting where we have a credit rating, which is, we at least know what it's meant to do. It's meant to tell us whether the borrower is more or less risky, and we have some idea of how it's meant to feed through to real actions and outcomes like default, okay? I would also suggest that it's a great setting because surely if organizational design matters, it must be in organizations like banks, which we think are primarily about obtaining information and using that private information to make educated decisions, okay? We're going to look at a large Chinese state-owned bank, and they're going to argue that the rating assigned to borrowers after an organizational change becomes a better predictor of the interest rate that they end up assigning, the size of the loan, and the loan performance. And there are other, and also the default as well, and there are other outcomes which I'm not going to go through in my discussion today, okay? As a second component of the paper, they then look at does communication have a larger impact when you have a longer relationship with the manager who's using the information that you're producing. In the interest of time, I'm going to basically set that part aside and just drill down on the first experiment on how does the organizational change affect communication within the firm, okay? So let's begin by pointing out, let's understand what exactly the change was. So it's easiest to think about this by first of all, in the post-reform period, the lending process was broken into 5 steps. So there was one officer who is in charge of what's called investigation, so basically meets with the client, prepares an initial report, and that's the person who assigns the rating, okay? And so it's essentially, we'll think of them as the agent. Then there's steps of verification, which I'm not sure I totally understand, but I think that's sort of checking up on the information that's been obtained, deliberation, and then ultimately the manager at the branch then will approve the terms of the loan, okay? And so he's using the credit information that they've gotten from the investigator, and particularly the rating, okay? And so we're looking at whether or not that rating becomes more useful in setting those credit terms. And then finally, there's a fifth role, which is monitoring and chasing up on the payments of the loan, and so on. In the pre-reform period, all of those functions are basically taken together and they're done within the branch as a combined team. Okay, and so the question here is delegating that decision to one officer and then making that officer responsible in some way, even though we don't see his incentives, we're told that he now, if he assigns incorrect ratings, bears some responsibility in his career for that. Does that change the communication process, and do we see ratings become more informative as a result? Okay, just a few initial questions which I don't think are going to take us very far. Is I first sort of wonder, should we think of this as purely an organizational change, or also just a change in the power of incentives? Okay, so was it the case that the team bore responsibility for incorrect ratings before, and now we've simply delegated, or have we now just incentivized the bank to give accurate ratings, someone in the bank to give accurate ratings? It's not also clear which of those theories in that long list we've written down we could really accept or reject based on this. So this could easily be evidence if we find something in favor of, say, Holmstrom moral hazard in teams, okay? So it might be that if you give the job to one person, you can incentivize them better and there's less free riding and so on. I'm also wondering about what other organizational changes are going on within the bank. So this seems like a time of turmoil. I'm not sure what else is happening in the way that they're structuring their lending process, but that's a very sort of open-ended and not particularly useful question. But those are concerns in the back of my mind, okay? So how are they going to do this? The question is that rating more useful? They're going to run regressions of the following sort. So we're going to regress outcome variables like the interest rate that the manager chooses, or the loan amount that they set, or ultimately how the loan performs, so whether or not it defaults. And they're going to regress that on the rating. And then the rating interacted with the post dummy. So beta 2 is the coefficient we're interested in. If that's positive, then, or whether that's negative but statistically significant, then we're going to interpret that to say that the rating is more useful in the post period. There are time dummies, there is an industry dummy, and a city dummy. And then there's a bunch of other controls, and I'm going to pull out one just because I'm going to come back as a talking point later on. And so, for example, we're going to control for whether the borrower is a state-owned enterprise or not. Okay, so those controls are stuck in there, and then also themselves interacted with the post variable. And there's a bunch more of them. I'm just pulling one out just to keep it simple for myself. Okay. All right, so let's remind ourselves what is the identifying assumption here. Okay, so we've only got a change in the way that the lending was done over time, so we don't have any control group to build a sort of credible counterfactual to. So what we really need to believe then is that absent the organizational change, that the correlation between credit ratings and the outcome variables that we're interested in, interest rates, lending amounts, and so on, would not have changed. Okay, that's essentially what we're identifying off. We're saying that the relationship between those two would have remained constant had we not have reorganized what's happening within the firm. Okay, and there's a few reasons why I'm a bit concerned about that. Okay, one is that there's a lot of things different between the pre and the post-reform period. Okay, and QJ is probably more aware of these than I am, so I'm not telling him anything new. But if we look for the number of loans that are being issued per year, that number is much higher. Now, I think this is partly to do with the sample being slightly off, so I'm not claiming that fully represents that, but it looks like they're doing a lot more business. Now, maybe if I learn by lending to other people in your industry and so on, then maybe that makes ratings more informative and that will improve the relationship, right? So the correlation could go up because of that. The firms are much bigger. So maybe if there's fixed costs in doing monitoring, then it makes more sense for me to spend more time and to develop a better rating, and the correlation could change and improve because of that. Okay, firms are more profitable, so maybe it's worthwhile developing more time, building the relationship. I can lend to them going forward. There's a much lower fraction of state-owned enterprises that are borrowing from the bank in the post period. And if I'm worried about political interference, basically meaning that we have to make nonsense loans, then that could potentially drive a big increase in that correlation. We're making more sensible private loans in the post period. The loan size is much bigger. That kind of goes along with earlier comments. And we notice also that there's something very seriously different in the sense that only about 54% of loans are repaid in full in the pre-period, where there's about 87% are paid on time in the post period. Okay, so it really looks like the standards of lending have changed in a noticeable way, and maybe if we're being more serious about lending in the post period, it makes sense that ratings are more informative. Okay, and also this rating band has changed. Let me not skip over that in the interest of time. Okay, so let me add some more things. So we also know that the economy is performing better, that there's an increase in banking competition. Okay, so outside of the top four, about 25% of lending is accounted for other banks. In 2001, that is doubled by 2008. So bank lending might be more competitive, and we might be worried that government interference is time varying. So one reason is because we're lending to a lot less state-owned enterprises in the post period. It could be that entry to the WTO means that and the whole reason for the reforms means that we're doing more commercially driven rather than politically driven lending. And there's plenty of examples and even a case study in the appendix that indicates that this is a potentially very strong force in the data here. Okay? So of course the point is that we run regressions for a reason and we try and control for stuff. So let's go back to this issue of, say, state-owned enterprises. Suppose I'm worried that in the pre-reform period, a lot of the lending that I do is basically the outcome of some political process. It doesn't make sense to assign a sensible loan, or someone picks up a phone and overrides it anyway. Okay? So what do we do in the regression here? We control for whether it's a state-owned enterprise, and we interact that with what's happening in the post period. Now that will pick up for a change in the level of the interest rate that might be induced by being a state-owned enterprise, but it's not going to do anything to control for the fact that the rating may become more correlated with the interest rate. Okay, so all that's going to do is allow for the level of the interest rate to change pre and post, but it's not going to adjust for what we're really interested in, that slope could be changing due to an induced change of the correlation between rating and whatever we're looking at, interest rates, lending amounts, and so on. Okay. Now, partly this concern is allayed a little bit in some unreported regressions in the paper. So in those regressions, they keep the sample of firms pre and post fixed. So at least the mix of state-owned enterprises isn't changing, so we can drive that out. Although I really think that's an interesting regression that ought to be in the paper and not unreported. We could do better. We could perhaps just leave the state-owned enterprises out if we're really worried about this. Or we could just, we could also estimate a separate slope for each group. Okay, so we could just have a triple interaction between that and the post group as well. Okay, but there are a lot of other things that are changing. Okay, so this is only one thing I'm concerned about. We're also, we've got change in competition. So in another set of unreported results, they control for whether or not there's a lot of competition in the area. But again, the same criticism applies. It's that it's going to control for a change in the level of, say, the interest rate, but not an induced change in the correlation between the credit rating and the interest rate again. Okay, so I'm just repeating the same logic, but with a different concern. Okay, and so I could still go on. I could now make a laundry list, and that would get extremely annoying and run me completely out of time, which I only have 1 minute of. So we don't really want to keep going. So I'm not sure what else to say in the sense that there's about 1.5 years between the pre and the post period. So I guess one thing I'm asking is, probably being very optimistic, was there any staggered introduction? Okay, so maybe we could look at, identify something off the change in one branch, change its organization before another, and maybe we could make a cleaner job of that. Alternatively, they could at least take the dynamics very seriously. Do we see a change right at the time of the policy shift, or is it slowly happening over time, as many of these other induced changes are? Okay, so just to summarize, I think this is an incredibly important research question. Providing empirical evidence here is extremely hard, so I'm taking cheap shots in a sense. I think this is a very worthwhile study, but we need to be concerned about other factors that may be driving the results, and it might be difficult to control for an endless list of factors, just chucking more stuff in the regression, maybe trying to tease out some other way to get it that would be more convincing. Okay, thank you.